Have you ever noticed how the dividend investing community feels less like a financial strategy and more like a religion? They talk about mailbox money and buying back your freedom with the passion of a Sunday morning sermon. They will show you spreadsheets of their monthly payouts, proving that they are getting paid just to exist. And on the other side of the fence, you have the quiet, almost boring index fund army. They tell you to buy the entire market, reinvest everything, and touch nothing for 30 years. It is the ultimate clash of financial philosophies. On one hand, the cash flow now camp. On the other, the total return later camp. Both sides claim they have the math to prove they are right. Both sides claim their way will make you richer, faster, but here is the catch. One of these sides is relying on a fundamental, psychological illusion, a mathematical magic trick that makes you feel like you are winning while you are actually leaving hundreds of thousands of dollars on the table. Today, we are going to strip away the emotion, the hype, and the lifestyle marketing. We are going to run the real math on a $10,000 investment over 30 years to see which strategy actually leaves you with more money in your bank account. And the answer is going to make a lot of people very angry. To understand why this debate is so fiercely contested, we have to look at the psychological trap of dividends. There is something deeply satisfying about seeing cash hit your brokerage account. It feels like a wage. It feels like a reward. If you own a stock that pays a 4% dividend and you have $100,000 invested, you get $4,000 a year just for holding it. It feels like free money, but this is where the math trick begins. Let's look at what actually happens when a company pays a dividend. Imagine you own a business, and that business is worth $100. Inside the cash register of that business, there is $10 in cash. If you decide to take that $10 out of the cash register and put it into your personal wallet, how much is your business worth now? It is worth $90. Your total wealth hasn't changed. You still have $100, it's just that $90 is in the business and $10 is in your pocket. This is exactly what happens on the stock market. On the ex-dividend date, the day a company officially pays out its dividend, the stock price of that company drops by the exact amount of the dividend paid. If a stock is trading at $100 and it pays a $2 dividend, the stock price immediately drops to $98. The dividend is not an extra bonus. It is not free money created out of thin air. It is a forced liquidation of a portion of your investment. You are essentially reaching into your own pocket, pulling out your own money, handing it to yourself, and celebrating. So, why does this matter? It matters because of a silent, wealth-destroying tax drag. When you invest in a broad market index fund, like one that tracks the S&P 500, the primary goal is capital appreciation. The companies inside that index, companies like Apple, Amazon, and Nvidia, take the profits they make and reinvest them back into the business. They build new factories, hire better engineers, develop new AI chips, and acquire competitors. Because they are reinvesting their cash to grow, the value of the company goes up, which means the stock price goes up. You do not pay a single cent of tax on that growth until the day you decide to sell the stock, which might be decades from now. Your money compounds in a tax-sheltered bubble. Now, look at the dividend investor. They buy high-yield dividend stocks or dividend ETFs. These companies are typically mature businesses. Think utility companies, telecommunications, or consumer staples. These companies have passed their hyper-growth phase. They don't have highly profitable ways to reinvest their cash, so they pay it out to shareholders. But every time that cash hits your account, the taxman is waiting. In a standard brokerage account, those dividends are taxed in the year you receive them. Even if you have set up a dividend reinvestment plan, a drip to automatically buy more shares, you still owe taxes on that distribution today. You are paying taxes on money you didn't even use to buy groceries. Let's run the numbers to see how devastating this tax drag really is. Imagine two investors, Sarah and Michael. Both start with $10,000. Sarah chooses the index fund route. She invests in a low-cost S&P 500 index fund. Over 30 years, let's assume the historical average return of 10% per year. Because her investment is focused on growth, She experiences very low dividend payouts, let's say a 1.5% dividend yield. With the rest coming from price appreciation, Michael chooses the dividend route. He wants cash flow. He invests in a high-yield dividend portfolio yielding 5% per year. Let's assume the total return is also 10%, meaning his stocks grow by 5% in price, and he gets 5% in cash. To make this completely fair, both Sarah and Michael reinvest 100% of their returns. Neither spends a single dime. They both have a 15% dividend tax rate. After 30 years, Sarah's $10,000 index fund has compounded beautifully. Because her tax drag was minimal, her portfolio has grown to roughly $162,000. Now look at Michael. Even though his total return before taxes was the exact same 10% as Sarah's, the annual tax bill on his 5% dividend payouts acted like a slow leak in his wealth bucket. Every year, a portion of his compounding power was shaved off and sent to the government. After 30 years, Michael's portfolio is worth roughly $128. By choosing the high-yield dividend strategy, Michael lost over $34,000 to the tax drag. That is a 21% penalty just for wanting to see cash hit his account along the way. And remember, this is on a small $10,000 investment. If we scale this up to a $100,000 starting portfolio, Michael loses over $340,000 to the exact same math. But the dividend defenders will immediately point out a flaw in this scenario. They will say, what if I hold my dividend stocks in a tax-advantaged account, like a Roth IRA? It is a valid point. In a tax-free account, the dividend tax drag is neutralized. Michael wouldn't pay taxes on his annual payouts. But even in a tax-advantaged account, the dividend strategy still faces a massive structural hurdle, the growth problem. Why do companies pay high dividends? Because they cannot find a better use for their cash. Think about it this way. If Apple has $10 billion in cash, and they believe they can reinvest that money to build a revolutionary new product that will yield a 20% return on investment, they will keep the cash and build the product. That reinvestment drives the stock price up, making shareholders incredibly wealthy. But if a legacy telecom company has $10 billion in cash, and they look around and realize their market is fully saturated, they might only see opportunities that yield a 3% return. Instead of wasting the money on lower-term projects, they decide to give it back to the shareholders as a dividend. When you bias your portfolio heavily toward high dividend-paying stocks, you are systematically filtering out the most innovative, fast-growing, high-return companies in the world. You are trading Apple, Microsoft, and Amazon for energy utilities and consumer packaging companies. You are trading future-shaping growth for stability. Over the long term, this bias costs you dearly. If you look at the historical data comparing the S&P 500, which is market cap-weighted and dominated by growth and tech, to high dividend indexes, the total return of the broad market consistently outperforms the dividend-focused strategies over long horizons. There is also the hidden danger of the dividend trap. Many beginner investors look at a stock offering a 10% or 12% dividend yield and think they have found a gold mine. What they don't realize is that an exceptionally high dividend yield is often a warning sign of a dying company. Because dividend yield is calculated by dividing the annual dividend by the stock price. A crashing stock price makes the dividend yield look massive. If a company's business model is collapsing, its stock price might drop from $100 to $20. If they haven't cut their $5 dividend yet, the yield suddenly looks like a mouth-watering 25%. But that dividend is unsustainable. Within months, the company will likely slash or eliminate the dividend entirely, and you will be left holding a permanently damaged stock. So, does this mean dividend investing is completely useless? Is it just a scam designed to appeal to mathematically challenged investors? Not necessarily. But to understand its true value, we have to look past the wealth accumulation phase and look at the retirement phase. The hardest part of retirement planning isn't saving the money, it's spending it. For 30 years, you have been trained to save, invest, and never touch your principal. Psychologically, Transitioning from accumulator to spender is terrifying. Selling your index funds to fund your lifestyle feels like cutting off pieces of your own golden goose. This is where dividends offer a massive psychological benefit. If your portfolio generates $50,000 a year in dividend income, you can live on that cash flow without ever having to click the sell button on your brokerage account. Your share count remains exactly the same. You feel secure because your principal appears untouched, even though, as we established, the stock prices fluctuate to account for those payouts. But even in retirement, the math of making your own dividend by selling shares of a broad index fund often beats the high dividend strategy. Let's say you need $40,000 a year to live on. Under a dividend strategy, you must find a portfolio that yields enough cash to meet that need. You might have to tilt your investments toward riskier, high-yielding sectors to get that cash, exposing your nest egg to structural decay. Under an index fund strategy, you simply sell for % of your portfolio every year. This is called creating a synthetic dividend. Because you are selling shares, you only pay capital gains tax on the growth of those shares, not the entire amount you withdraw. This is often far more tax efficient than receiving forced dividend payouts. Furthermore, your remaining money stays invested in the most productive, fastest-growing companies in the world, allowing your principal to keep pace with inflation far better than a portfolio of stagnant utility stocks when you run the real math. The conclusion is clear. During your wealth-building years, biasing your portfolio toward high-dividend stocks is a suboptimal strategy. It introduces unnecessary tax drag, filters out the most profitable companies in the world, and exposes you to value traps, all to give you a psychological warm and fuzzy feeling of seeing cash hit your account. If your goal is to have the largest possible net worth 30 years from now, the math says you should buy the broad market, ignore the dividend noise, and let the world's greatest companies reinvest their own profits to grow your wealth. Dividends are not free money. They are just your own money, returned to you at an inconvenient time with a tax bill attached. Build the biggest pile of wealth you can first. You can always figure out how to spend it later.